Everyone told you the same thing. Buy a house, build equity, stop throwing money away on rent. It's the smartest financial decision you'll ever make. And for decades, that advice went completely unchallenged. It was passed down from parents to children like gospel. But what if the numbers don't actually back it up? What if the house you're killing yourself to afford, the one you're skipping vacations and sacrificing savings for, isn't the investment everyone says it is? I'm Dexter. Most people won't tell you this because it goes against everything the real estate industry wants you to believe. Subscribe and let's get into it. Let's start with the comparison nobody in real estate wants you to make. Between 1992 and 2024, the S&P 500 returned an average of 10.39% annually. After inflation, that's a real return of 7.66% every single year, consistently over 3 decades. Now, let's look at housing over that exact same period. U.S. home prices grew at a nominal rate of 5.5%, which after inflation gives you a real return of just 2% to 2.5%. And here's where it gets really uncomfortable. Nobel Prize-winning economist Robert Shiller studied housing data going all the way back to 1890. His conclusion after analyzing over a century of data, the real annual return on home prices was just 0.4%. Not 4%, not 40%, 0.4%, barely keeping pace with inflation for over 100 years. But you've been told renting is throwing money away, right? That's the line everyone uses. Here's why that argument falls apart the moment you actually look at the math. When you rent, you're paying for shelter. You're exchanging money for a place to live, the same way you pay for food, transportation, or a phone plan. You get real value for every dollar you spend. But when you own a home, there are costs that never stop, never return to you, and most buyers never see coming. Financial analysts call these the phantom costs of homeownership. They add up to roughly 5% of your property's value every single year without fail. That breaks down to approximately 1% in property taxes, 1% in maintenance and capital expenditures, and 3% in cost of capital, which includes your mortgage interest and the opportunity cost of your down payment sitting locked inside a house instead of working for you in the market. On a $400 home, that's $20,000 a year, quietly draining out of your life before you've gained a single dollar in real wealth. And most homeowners never add that up. Now, let's talk about that opportunity cost, because this is the part that changes everything. The typical down payment on a home today sits around $79,000. If instead of handing that to a bank as a down payment, you invested that same $79,000 into a diversified portfolio, returning just 6% annually, in 10 years, you'd have approximately $159,000. Sitting inside home equity, that same money grows at maybe 2% to 3% in real terms, and you can't easily access it without selling the house or borrowing against it. You've taken your most powerful financial asset and locked it inside an illiquid, high-maintenance, non-diversified single investment with no flexibility and no liquidity. And you did it while also paying interest to a bank every month for the privilege. Here's something the real estate industry definitely doesn't put in their brochures. The average American homeowner stays in their home for just 13 years, but almost every mortgage being sold is a 30-year loan. In the early years of a mortgage, the overwhelming majority of your monthly payment goes toward interest, not principal. You're not building equity nearly as fast as you think you are. And when you factor in closing costs of 2% to 5% when you buy, plus broker commissions and fees that can easily exceed 10% of the sale price when you sell, you need to stay in that home for at least a decade just to break even on the transaction costs alone. Most people don't stay that long, which means most people are selling at a loss they don't even realize they took. And then there's the risk side of this that almost nobody talks about before they sign the papers. If you bought a home with a standard 20% down payment and your local housing market drops by just 10%, You haven't lost 10% of your investment, you've lost 50% of your equity because you're leveraged. A small move in the market hits your actual stake in the property dramatically harder than most people expect. And unlike a stock portfolio where you can spread your money across hundreds of companies, industries, and countries, you cannot diversify a house. Your entire net worth is sitting in one asset, in one zip code, completely dependent on the local economy, local job market, local supply, and local demand. If that neighborhood declines, you decline with it. There's no hedge, there's no exit that doesn't cost you significantly. Now, to be completely fair, and this matters, homeownership does offer real, non-financial benefits that have genuine value. Stability, the ability to customize your space, a sense of permanence and community. And it does function as a forced savings mechanism, because for a lot of people, making a mortgage payment every month is the only consistent way they actually accumulate any wealth at all. Those things are real, and for the right person in the right market, buying at the right time and staying long enough, homeownership can absolutely work out well financially. But that is a very different thing from what most people are told. The narrative that buying a home is always the smartest financial decision, that renting is always wasting money, and that your house is your most valuable investment, that narrative is not supported by the historical data. The returns are lower than the stock market over almost every meaningful time period. The hidden costs are real, they're significant, and they compound quietly for decades. The opportunity cost of your down payment is something almost nobody calculates before they sign. And the liquidity risk of having your net worth concentrated in a single illiquid asset is something most people don't feel until they desperately need to access their money and can't. The goal isn't to never buy a home. The goal is to go in knowing exactly what you're buying and why you're buying it. If you're buying because you want stability, because you want to put down roots, because you want a space that's fully yours, those are completely legitimate reasons. But if you're buying because someone told you it's always the best investment you'll ever make, it's worth pausing and running the actual numbers first. Because a house is a place to live, and that has real and genuine value. Just don't confuse it with a wealth building machine. Because a century of data says it isn't one. If this made you see homeownership differently, subscribe because we drop new videos every week. And I want to hear from you in the comments. Do you still think buying a home is the right financial move, or has something shifted for you after watching this? See you in the next one.